you're struggling to understand liquidity because you want to become a consistently profitable trader, and you know that liquidity could be the missing key between you and profitability. But up until now, you're lost and confused because everywhere online, everybody seems to make liquidity such a complicated idea. Well, stick with me, because in this video, I'm going to simplify liquidity to a point where it's very easy to understand. In this video, we'll cover what is liquidity and why it works. Then we're going to cover the most common types of liquidity and how to identify them. Then I'll walk you through the biggest mistake that I see traders make when it comes to liquidity and how you can avoid making that same mistake. And then finally, I'll walk you through my smart money manipulation trading strategy that incorporates these liquidity concepts into a trading strategy that you can replicate and try for yourself. Okay, so just a brief run through. This is going to be the trade that at the end of this video that I'm going to walk you through step by step and show you how we incorporate liquidity to get into this position. But before we do that, let's go ahead and get into the core concepts of this video. Okay, concept number one, and again, a very, very simple concept, is what is liquidity in trading, right? You first and foremost have to understand what exactly it is that you mean by liquidity. So what do we mean by liquidity in trading? Simply put, liquidity just refers to money. When you want to identify areas of liquidity, you need to ask yourself, where is the money? And money in the markets can only come in the form of three different ways. It can only come in the form of entries, stop losses, or take profits. Every time you get an entry, you deploy liquidity into the market. Every time you hit your stop loss, you deploy liquidity into the market. Every time you hit a take profit, you deploy liquidity into the market, and so does everybody else. So when asking yourself how to identify key areas of liquidity, what you really need to ask yourself is, where is everybody's orders? Where is everybody's take profits? And where is everybody's stop losses? And that is exactly what I'm going to show you. So this is a very simple diagram of understanding the most common liquidity concept, which is dumb money, right? What you want to be thinking about is, where is everybody's stop losses? Where is dumb money stop losses, right? Where are their orders? Where are their stop losses? And if any of them are in profitable positions, where are people looking to take profits, right? Liquidity is actually a very psychological thing. You have to understand that groups of traders form collective biases based on trading ideas, ideologies, and strategies. So many different traders trade many different strategies collectively. So you can identify these strategies and begin understanding where all the liquidity is. If we know that liquidity equals money, stop losses, entries, take profits, we need to identify where are people putting their orders, where are people putting their stop losses, and where are people putting their take profits. And so here are some very simple ideas of how you would identify some liquidity. Then we'll go and take a look at what this looks like in the markets. So you can see here, we say, we have a price leg, push up, pull back, right? So you can quite clearly see that, from our landscape, smart money, we're bullish, right? We can see we have bullish market structure. But what we have is we have this trend line forming down here. So there are a lot of traders that are looking at this and they're seeing this trend line. And again, these are the trend line traders. And many of these traders, when they're looking at this market, they have an ideology of wanting to go long. Their trading strategy indicates to them that price is going to continue trading higher. So what do? Well, they're going to wait for one more touch of this trend line. They're going to try and, probably enter into try to get the next touch. So we have one, we have two, we have push up. So maybe they have their entry somewhere in this region in here. Maybe they're looking at, this old low down here as an area in which they could potentially look at putting their stop loss. And where do you think they're probably going to target? Well, psychology indicates that many traders use old highs, old lows for their take profit placement and their stop loss placement. Think about it. Think about you as yourself. Where do you place your stop losses? You place your stop losses at some sort of low, which you think should be respected. You place your take profit at some sort of high you think should be disrespected. Well, all traders pretty much think very similarly. So this is what the typical kind of trend line trader who would be looking at this would be looking at. Then you have the opposite side of the spectrum. You have a certain caliber of trader who's looking at this market and says, okay, well, we've been trading high for a long amount of time now, and we begin to reject this random key level, right? This random key level that they created from the past that has no relevance of current price action, but let's just say it means something. They have these key areas mapped out. They say, okay, price is rejected from this key area, and then price is pulled back into this same area and rejected it again. So that must mean that this is a key level. This is an area of resistance. This is a double top. This is an area that is protected. So I want to get involved. So they try to get involved in some sort of short position, right? So they may put their entries up at this level when price comes back. They're probably going to put their stop losses at the highs up in this level. And then they're probably going to put their take profits, anywhere, kind of some old lows, wherever they may put their take profits. But then you're going to have something that looks a little bit like this, right? You're going to have some traders who are looking to long because of this trend line. You've got some traders who are looking to short because of these, relatively equal highs or this double top or this area of resistance, right? And then what else do you have? Well, maybe the market then gives you something like this. You have a little bit of a reaction, right? And then what happens? What happens is a new caliber of trader also enters the market. A new trader enters the market and goes, oh, look, we have this trend line, we're bullish, we have structure, they have an understanding of structure, we have some great structure, amazing. And now prices traded out of here, we've come back in, now we're having a little bit of a reaction. So what am I going to do? I'm going to long this reaction, right? So then they're trying to get involved. And so we can literally just paste this again. Now we have another caliber of trader trying to get involved, put in their stop loss where? Probably at this low. Entry somewhere around the same level, take profit somewhere at this high, right? That's another type of trader. Then again, you may have more of the same trader, let's say trend line traders, right? So you've got 1 touch, 2 touch, 3 touches, they're looking at getting involved and they're waiting for what? They're waiting for some sort of reaction from this trend line point. And so when they begin getting this little reaction, again, that is when they may jump in the market and where they're going to put their stop losses in these similar areas, right? So what I'm kind of building the narrative for you is understanding that something as simple as 2 legs on a price leg can have so many different traders getting involved in the market for so many different reasons. And it's your job to identify who those traders are, what strategies they likely trade, where their entries likely are, and where their stop losses likely are. And it sounds difficult, but it's actually very simple. All I've gone through is a trend line trader, a resistance type trader, a double top, a double bottom, a trend line confirmation, right? Very, very simple level trading strategies that a lot of traders try to trade. And these types of things, these patterns that you see, they're set up intentionally. They're set up on purpose because smart money knows that the information that you're getting online, the information that your broker's feeding you, it's all retail-based concepts or dumb money-based concepts. It's all pattern recognition. There's no causation to the price movements. Everything is, trying to identify something based on something that doesn't exist. And so it sees all of this liquidity that's building, all these different type of traders that are trading these outdated styles of trading with all their stop losses and their entries. And smart money knows this, right? And so we have all these different pockets of liquidity in just one random scenario. And so now what you have is a bunch of stop losses in here. You have a bunch of take profit levels in here, right? You have probably a bunch of take profit levels in here from sellers. Then what else are you going to have? Well, any market movement that we get from here on out, now you've got the traders that are kind of waiting, right? The breakout traders or the break and retest traders. And what they'll be waiting for is some sort of direction. For example, if price continued trading higher and broke out of this high, so many traders would jump involved and start longing the market up in these regions. When it breaks out, they long, they may put their stop loss below this low. They may put their stop loss, inside of some internal low inside of here. But basically, they are going to be longing and they are going to be putting stop losses in these areas as well when it breaks, right? Again, you have the same thing on the opposite side. When the market, let's say, has some sort of continuation and then it rejects from here and it takes out these lows, what you're going to be getting is you're going to be getting all the breakout traders that are trading this breakout and they're getting involved in the market here. Their stop loss goes above these highs in here, right? Their take profit goes, down here. And then again, you have the break and retest traders, right? Those are the ones that wait for the price to break, but then they wait for it to come back, right? And then they go to short. And it's the same thing. They have their entries in here, their stop losses up here, their take profit levels down here. So you can see just in this one little schematic, how many different traders would read the same piece of data and all come to different conclusions. But primarily what we're seeing is they're all putting their money on their bias, right? They're putting their money in these levels. Now what I want to do is run you through the simple framework in which I use and is which, what smart money concepts is about, in how we would interpret this exact same price action so much more simple just by understanding liquidity and understanding all the other types of traders and where their stop losses are. And it goes something like this, right? First and foremost, you have to understand, why is that liquidity? Why before a very big move, and this is something you've probably seen, right? You may have been long before, you had a bias to go long, and you had your stop loss in here, and then price just come into your stop loss before going in the direction that you wanted it to go. And you probably sat asking, why does that always happen to me? This is the reason. The reason is because before smart money move the price aggressively in a certain direction, right, which is their bias, that's their intention, it's their footprint. Before they do that, they will engineer liquidity on both sides of the market for this purpose. You see, smart money are very, very big players. When they move a large amount of money. And the market is very simple marketplace. It is pretty much for every buy order, there needs to be an equal sell order on the other side. And so because smart money have so much money, let's say they wanted to, buy euro US dollar long term. Well, they would need to get their orders filled at the price they want to get their orders filled at. So let's say they want to get their orders filled at this level here, and they want to buy here. They need an equal amount of sellers to be present at that level so that they can get their orders filled. So what they do is they create artificial dealing ranges, right? They'll push price in a certain direction to trick people into having an opinion, having a bias, because when they have that bias, like we've just looked at, all these different traders that are looking at this market, and lots of them have stop losses here, entries here, take profits here. When they've been able to manipulate their thinking to put in their liquidity into the market, then they're able to use that liquidity to get a better average of their orders filled at the prices they want to get their orders filled at. Because if they wanted to buy and they first sold, they created these patterns, they created these little equal lows here, they had their little push up to make everybody, ready to want to buy in here. And so they have their stop losses down here. And then anyone who sees it break now wants to sell. They do that so that then when they move price into here, into where they really want to buy from, right? Then all of these sell orders from the stop losses of the buy orders, from the sellers who are getting involved because they think price is going lower, they absorb all of that liquidity with their buy orders, right? That is the game. So that is why they manipulate price. It's not just this kind of like conspiracy theory as why it works. No, there is literally the reasoning and justification behind why price does it. So how would we view the same market through the lens of smart money? Well, number one, directional bias. That's always number one. We need to understand what is the direction of the market. Because one thing that smart money can't hide is they can't hide their intention. They can't hide their footprints. Because the reality is when they move the market moves. You can't hide that. So if price is trending in a certain direction, like you can see here, right? We have a swing low, swing high, higher low, higher high. When price is put in this structure, it's undeniable that the market is bullish and that it's going to have higher prices because that is their intention. It's undeniable. They've already shown us. They can't hide it, right? So our directional bias is our first and foremost bias that we need to have. So in this scenario, you can see that we're bullish. So our directional bias is bullish. We are looking for long positions. But then when you see price begin to build these little internal ranges, what we see is we see trendline liquidity across these lows, right? So we can put liquidity across here. We have all of this liquidity down here, trendline liquidity. We have equal highs across the highs up in here. We have, relatively equal lows in these areas in here, right? Liquidity. And then we have probably some sort of reaction in price that pushes more buyers into the market, stop losses under here. We identify all of this in the same lens that I've just shown you when we mapped out all of the dumb money. And then we identify, okay, where is the area in price where we can avoid all of that liquidity that includes taking out all of that liquidity and is below that area of price? We would identify an area of interest, right? An order block, an area of interest below areas of key liquidity. And then we wait for everybody else to get stopped out, or most people to get stopped out. And then when price gets into our area, we wait for some confirmation. And then we go long, right, into here. And then we wait for these guys to get manipulated. We wait for these guys with the stop losses here to get manipulated. And then we get in with the real move of smart money. And we just target the next logical area of price. And that is literally what my smart money model looks like. And that's something that we'll get into in just a moment. So to recap, liquidity is money, and money is stop losses, orders, and take profits. You want to see where the liquidity is? Get in the minds of dumb money. Where are they putting their orders? What trading strategies are they using? And once you can see that in the charts, the trend lines, the equal highs, the support, the resistance, right? Once you can see those patterns, then you can begin to ask yourself, where would those guys put their entries, their stop losses, and their take profits? And those are the pockets of price you need to mark out as your liquidity, because that is where there is resting money sitting. And smart money, like a shark, is coming for those pools of liquidity. So why everyone gets liquidity wrong, and what you need to do to make sure that you don't fall into this trap. The key is they have no context, right? So if we look at this diagram that we have right here, what we can see is that, we have equal lows down here, right? So this is an area of, old level of support or equal lows. So we know that's liquidity. What do we have? We have trendline liquidity building, right? We have a lot of trendline liquidity building. So again, we know there is a lot of liquidity. And even if you zoom out, you can see on the bottom side of things, you can see actually this is one big trend line as well. So we have one big trend line, we have micro trend lines within it, we have equal lows, we have again this large trend line down here. And what else do we have? We have equal lows across here, right? So more liquidity, and we have equal highs across here. So more liquidity. So these are our pockets of liquidity, is what I like to call them. These are the areas in which there is liquidity. But the issue that a lot of traders make, and maybe you're making this yourself, is you think that because you have these areas of liquidity mapped out, that now you think you know where the market is going, but you lack context. You think that just because there is liquidity in a certain area, that means price has to go there, or price will go there, and price will go there now. And that's where many traders are wrong, because what they'll try to do is they will try to trade solely based on understanding liquidity. They'll say, okay, I see that there are stop losses in here, therefore the market is going to trade there. When the reality is you need context. Everything needs to be seen through the lens of context. Because here's how I would see it. If I look at this market right now, I would tell you, step number one, always form your directional bias first, like I've just explained to you. So it would be step one, identify our key areas of structure. Where are we trending, right? So we have swing low, swing high, swing low, higher high, higher low, higher high, higher low, higher high. Great, we're bullish. Now, where is my most recent swing range, right? I need to find the swing low to the swing high. So where's my most recent? Well, my most recent swing low is here, and my most recent swing high is here. So now I have my trading range. And this is the current present moment trading range that we're operating in. So if we're bullish and my swing low is here, my swing high is here, as of right now, right this moment, none of this sell side liquidity is important, right? Ignore this because it's not in context. There's no reason for the price to go lower until it's shifted its structure. So focus on market structure as your primary foundation. Market structure is like the building blocks of your trading strategy. Again, if you want more value from market structure, I have so many videos on the channel about it. But market structure is really your building blocks. And, you know, with it, we can see we have a swing low, we have a swing high. So that is our trading range. Inside of that box is our trading range. So I am now only interested in, number one, longing this market because market structure is bullish. Number two, which simply means now I have context, I'm only interested in the liquidity areas inside of my price leg. So if my swing low is swing low to swing high, I'm not interested in any liquidity that is outside of that context, right? So what am I interested in? I'm interested in these lows and I'm interested in these highs. And again, like I said, many traders will make the mistake. They'll think that because all of this liquidity is down here and this long trend line, that they can short because price is going to go there. And you know what? Price probably will go there. But it's not about understanding where price will eventually go. It's about understanding and becoming profitable is about knowing where price is going to go now. Where is its next move? That is how you make money. You don't make money by knowing when it's going to go in some random future point in time because there's a random trend line there. Because maybe it will go there. But by the time it's gone there, you've probably lost so much money that it doesn't even matter. So everything must be understood through context. And context is market structure. We have to understand that we are bullish. So until we have a change of character, until price shifts bearish, we don't care about the sell side liquidity that's at the bottom of the price leg. We'll cross that bridge if and when we come to it. Right now, we want to focus on what is in our control. And in our control right now is understanding that price is probably going to trade higher short term. And we need to get involved in those long positions to make money today. So how do we do that? We identify the areas of liquidity. So we have equal highs. So we know there is a lot of stop losses above here. We have equal lows. So there's a lot of stop losses below here. So what I would be doing and I would be framing is, okay, I want to long the market. Awesome. I want to probably be buying in an area of discount. Okay, so down in these regions in here. I want to identify a point of interest, right? An order block, an area of interest. Again, many videos on order blocks and areas of interest. I want to identify a key area of liquidity, which is these lows, these highs. I want to identify my order block inside of my discount level. And then I want to patiently wait for price to sweep that liquidity into my point of interest. Then I want to get my entry model, right? Which is my lower time frame confirmation. And then I want to buy using that. And again, what is it? It's the exact same model that we just looked at, right? We're waiting for the liquidity to be taken, and then we're waiting for the liquidity to be targeted. So that is why everyone gets liquidity wrong, because they lack context. And hopefully that gives you an understanding of how to incorporate context into your trading. So by now, you probably guessed it. My smart money manipulation model is actually a very, very simple one to understand. And this is just a recap from what we've just gone through. Step number one is identifying market structure. So we know that we have swing high to swing low. So we're bearish, right? So that's step number one. Am I bullish or am I bearish? What's my bias? Higher prices, lower prices. The way to identify that is market structure. Okay, cool. So if I'm bearish, then I'm only looking to short the market, right? And then let's say, you know, you can't see past this gray line. So what I then want to do is I want to probably identify an area of premium and discount, right? So I can just take the fib and identify, you know, the kind of this 618786 area as an extra confluence. Then I want to identify areas of interest, right? So points of interest, order blocks, areas of supply, areas of demand. Okay, great. And then what I'm looking for is as price approaches to this level, we're going to see a slowdown in price. And the reason for that is because now we're entering into the manipulation phase. What's going to happen is that price is going to start to print these repeatable textbook strategies that you see. So you're going to see trend lines that are trending down. You're going to see equal highs. You're going to see equal highs. You're going to see equal lows. You're going to see trend lines trending up. You're going to see all of these different types of internal liquidity models. And what we want to wait for is we want to wait for a run of all of this liquidity because we know that it's probably going to come. So we want to wait for a run of all of this liquidity in here, right? All of this liquidity, wait for everybody else to get stopped out. Because we know if they want to short the market, which they do because they're bearish, before they will short, they will long. And they will long because all of these sellers and all of the stop losses in this area is going to what? Help them initiate their positions. Initiate them and get better averages in their positions. So they will liquidate it all. And then what's going to happen is many people are now going to look at long positions because they're going to look at this and they're going to say, okay, well, we've just broken an area of structure. Price is very aggressive. Okay, buy. All their stop losses are in here, right? And then as they were buying, who was selling them their positions? Smart money, because they're getting ready to load up their sells in this level. So that is exactly why they will first buy into this to get a better average in this area. And then when they begin pushing price down, the momentum from stop losses, from other market participants, because of the aggressive move, will help take price down for them. So what we wait for is we wait for the manipulation and the initiation. This manipulation tells us, okay, smart money have done what smart money do. This initiation tells us, great, we are right because we are on track. Because remember, we're already bearish. We're expecting lower prices. Now we've had the initiation. That is very evident that a large amount of money has just been processed. We know that big money is now involved. And then we wait for the pullback, right? The mitigation. And then we get involved in this mitigation. And where do we get out? At the old low down in here. That is my smart money manipulation model. Okay, so now we're going to tie everything together full circle and cover what we've just learned and apply it to the live markets with a real life trade example. So step number one, and the most important thing, and the reason that most people get liquidity wrong, is context. And for us, context is always market structure, because market structure is going to tell us what direction price is going to trade into. And we only want to be trading in the overall direction of price. So to do that, 15-minute time frame, you can very clearly see we have swing low down here, swing high up in here, right? That's our swing low. That is our swing high. Everything inside of that is simply just internal. So swing low down here, we'll draw that across. We expect that to be respected. Swing high up in this region in here. And that is the direction that we want to trade into. Now, everything else is internal, right? But considering we are intraday traders for the majority of it, it's important to identify what our session is going to do. What is today's 4-hour time window, right? My London session window. What is the characteristic and behavior of that session? And if I can just get that right, I don't need to understand the higher time frame. I just need to understand what is London going to do. So to do that, again, just having a little bit of a look at internal structure, you can see that our external structure is bullish. And then our internal structure, we put in this low, we go high, then we go higher low. Now, the reality is if price wanted to continue trading lower, this high would have produced a lower low. The fact that it didn't, the fact that the low comes in and then begins trading out, indicates that now this low is protected, this high is targeted. And so when you see that this high gets broken, it's no surprise, right? Internal break of structure. Now you have low to high. And right now, coming up to, Friday London session, that is our current internal trading range. We're looking at trading from this low down here to this high up here. And that is our intra-session bias. And now it's very simple. It's literally just a case of my intra-session bias is long. I want a long price into this high up in here. That's step one. Step two is now I need to identify liquidity and points of interest. And so if I'm looking at price, I can see that already after putting in a higher high, so we have higher low, higher high, price has already pulled back. And now it's on its expansion phase. So I know that as London begins, I'm expecting that expansion, right? It's very, very obvious in price. We have low, higher high, price has already pulled back. The most probable scenario now is a higher high up in here. So if the highest probability is up in here, and we're not going to break this low anymore, then that means that I need to be longing, and I need to be longing above this level and obviously below these highs. And so that only gives me a small window to long in here. And so next, it's where are the logical areas that I can long from? So I'm looking for unmitigated areas of demand. what do I have? There's only one area in this level that's unmitigated, right? It's this level in here. This is the only level, and if you actually refine it to its candle, we have the fair value gap. This is the only level that is unmitigated. And so that's the only point of interest that we can look at trading from. What about liquidity? Well, we need to see sell side liquidity and buy side liquidity. So the first thing that I see, which is very obvious, is this massive trend line across these highs, right? This massive trend line across these highs, which is very obvious. So I know that there's a lot of traders that are looking at sells in these levels. So a lot of the side of the market, of the dumb money side, are selling, which is perfect because we want them to be selling. Because if they're selling, it's likely because smart money has set the trap so that they sell, so that we can buy into those sell positions. So that's good news. We expect our high to be taken out because we have structural context. Now we need some internal structure on the sell side. And what do we have again? We have more trendline liquidity, right? One touch out, second touch out, third touch out, potentially long traders looking to long in here. Stop losses, potentially in these regions in here for long traders, profit levels up in these regions in here. We also have, not only are this is a trendline level, these are also relatively equal lows, right? Old relatively equal lows. But the most important one for me is this is Asia session low. So those of you who have been around the channel for a long time know how much I love the Asia session low as a pocket of liquidity. So with that being said, I have all of my sell side liquidity set up. And so all I'm expecting is a manipulation, initiation, right? So the manipulation phase is step one, right? Manipulate into the sell side liquidity. Initiation is step two. Now I wait for a very large volume to come in for the buy side to confirm two things. Number one, to confirm my area is correct. Number two, to confirm that smart money are actively involved. Once I get the manipulation, the initiation, then I can just wait and get involved on the mitigation, and then I will ride the continuation. That is my model. It's the same thing over and over and over again. Let's see how that looks in real time. So 15-minute time frame, London session opens, and you can see that London session manipulates into my point of interest, and we take out all of the lows across here. So what happens at this point is I want to drop down to my lower time frame to wait for my momentum to kick into the market that will give me a change of character that will tell me on a lower time frame that price has now shifted bullish. I'll drop down to the 5-minute time frame. And now, really and truly, I'm just waiting for the internal high, right? If we look at things, we have low, price pulls back, high, and then low again. Wait for that high to be displaced. And then once this high has been taken out, I'll look at getting involved in the area that manipulated when price pulls back and then ride the wave up. And it's that simple. So we play price out. And then you can see what we have. We have the manipulation of all of the sell side liquidity. We have the initiation of smart money. Now I want to get involved on the mitigation. So typically, smart money would have had to use their liquidity to sell into this level to create the liquidity so that it could get its buy orders at a better average. So when the price comes back, they're able to close out any remaining sell orders that they had to use, any sell liquidity that they had to use to create this scenario. So they will, bring price back to be able to close relevant sell positions at minor losses or break even. That's when I'll get in, and then I will look again out at this swing high up in here, right? This old high, this target, this Asia high, this old high. That is our structural context and our liquidity context together. So we'll place a long position at this area of demand, right, that has its fair value gap, give a 4.5 pip stop loss, and we just want to go for a minimum 1 to 5 risk to reward, right, which is near about our swing high. And that is pretty much just what we are waiting for. So we'll play price out, see how price delivers on that. So you can see that price has tagged into this position and is now giving us the reaction out of this level, right? We can see we've tagged in, smart money, mitigation, and now we're playing the continuation in the direction of our overall bias. So you can see prices having these little internal swings, trading prices higher. And there you can see price manipulates into the take profit, 1 to 5 risk to reward. And just to recap, little 30-second recap on the overall understanding. Number 1, step 1, bias, context, right? We need to understand, is the market likely to trade higher? It's bullish. Our internal is also bullish. And so from an internal perspective and an intraday perspective, our London session should be bullish because we're expecting higher prices. We've already done everything that we need to do to get higher prices. Then comes liquidity and supply and demand, right? Those are secondary to market structure. We wait for our internal manipulation, wait for our initiation, which tells us we've manipulated sellers, we are now confirmed long, and we want to get involved on the mitigation process and get out on the continuation process. That summarizes the edge. If you want more of these strategies, more content just like this one, link down below has an entire free course, no strings attached. Enjoy.